I mentioned yesterday that I thought yesterday was a bull flag after the reversal up on Wednesday, and therefore the odds were we would go higher. And I also said that this is a major lower high, led to a strong breakout far below the prior low. And it's therefore a magnet, especially when the market's this close. I think we're going to get there, and I honestly think the odds are we're going to go at least a little bit above it. However, I don't know what will happen after that. I think the weekly chart is really interesting and important today. The market traded above last week's high and below last week's low, creating an upside down week. The bulls are very close to going back above last week's high, which would then turn the week into an outside up week in addition to being an outside down week. And I got last week's high is over here. I should highlight that. Well, I don't think we're going to get there. We might. So let me put that here. All right, that takes care of that. So bull trend, trading range, and breakout. And there are two measured move targets that you have in a situation like this. One is the height of the trading range, and the other is leg one, leg two. Leg one, pullback, leg two. I don't think that's realistic for today, but the height of the trading range is definitely possible. We don't know which height, which top and which bottom. One choice would be this low and that high. The market might consider this as an outlier and this as an outlier. And the measured move takes us to that major lower high right there. Yesterday began with a bull bar and followed by a bear bar. Day before began with a bull bar and followed by a huge bear trend. Today the bulls are trying to get a bull bar again. I think they have a better shot at an early trend today than yesterday, because yesterday was a big buy climax and it was probably going to have a hard time getting above the prior day's high. Today, on the other hand, is a bull breakout above a bull flag, and there are magnets above. And therefore, if the bar closes on its high, maybe a 25% chance that it will be the low of the day. Do you see one problem with this bar? Well, one problem, compared to the size of these bars and these bars, this bar is small. And that reduces the chances that it's the start of a bull trend day. It might suddenly get bigger in the final seconds. If it does, then it would be a higher probability buy for an early low of the day. We had a lot of trading range trading yesterday, and that reduces the chances that we'll go straight up today. Look at yesterday, past 3 days, all doji days. Even though this is a big day, it's mostly a tail and a small body, so it's a doji day. So right here, swingles, if they want, they can buy this. It's probably better to wait to see if we get consecutive bull bars, because look what happened yesterday. Traders who bought above one reversed down, and the same the day before. But I think the context is better here. We're breaking above a bull flag, and we have several magnets above the high of last week, the all-time high, measured move up from yesterday's range, and then that major lower high over here. So I think we're going higher, even if we do pull back here. I think we're so close to this that we should get there. And why this is important, because if we're in a bear trend, the rally should stay below prior major lower highs. If a rally goes above major lower high, then it's no longer a bear trend. It's then either a bull trend or a trading range. A lot of times it'll go a little bit above, convert the chart into either a bull trend or a trading range, and then the breakout above fails and it reverses down strongly, and it once again becomes a bear trend. The bears are already very disappointed by the size of this rally. So if we get above that major lower high on the 60-minute chart, no big deal. The bears, they should not have allowed this. So obviously they should not allow it to get above here. However, they'll hope it's a trading range and they'll look to sell the breakout. Okay, similar to yesterday, bull bar, possibly bear bar. I still think today is more bullish because this is a breakout above a bull flag after a very, very strong rally. Well, 2, if it closes on the low, like 2 yesterday, it can be the high of the day. However, I would not take the sell because the odds are this is a bull breakout above a bull flag, and we should go up at least a little bit more, maybe a couple little legs up. So while this could be the high of the day, I would like to see a couple big bear bars before selling, just like I wanted to see a couple bull bars before buying closes. A lot of trading range trading yesterday. That increases the chances of trading range trading today. I mentioned the weekly chart. Today's a Friday, so weekly support and resistance is important. It's unlikely that we're going to get all the way back down to last week's low. We're close to last week's high. We might get there. And I said that the third choice was the middle of the week. 50% pullback somewhere in the middle of the week. So that is another magnet. And since it's below the current price, that would be a support level. Okay, gap up, bull bar, bear bar, right? So early signs of a trading range. Suppose we get 2 bear bars. Okay, we're closing the gap above yesterday's high. Let's say we get 2 bear bars. Well, we'll probably go a little bit lower. Now this blue line, I left it in here because it's important. On Tuesday, we had a bear IOI sell signal. We had a sell signal here, it failed, and now we have a second sell signal here. We triggered the sell by going below Tuesday's low. However, we're back above Tuesday's low. A lot of times if you trigger a sell on a higher time frame chart, a daily chart, the market pulls back above the sell signal entry price and then tries to go back below it again. And therefore, Tuesday's low is a magnet. If the market falls below that blue line, it then triggers that sell on the daily chart again. Remember, Tuesday on the daily chart is a sell signal bar, a bear IOI. After a breakout, we trigger the sell. We're back above the sell entry price, and now the bears are trying to trigger the sell again. I don't think it's that meaningful after this big a sell-off, right? The bears had their trend down, and it ended. We went back up. And therefore, this sell signal, I think, is much less important. It would be more important if we went a few points below and then above, and then went down below a second time. That would be more important. A lot of the days over the past couple of weeks have had early big bear bars. that is a change in the market's behavior, and it increases the chances that the bull trend is transitioning. We know it's transitioning. We've been going sideways now for 3 weeks. Many of these days have had early sell-offs, and that's very different from these days where the market did not sell off much at all on the open. There's very small tails on the bottoms of the bars. Whereas here, the tails are getting bigger, and that means that there were bigger sell-offs on the open. All right, so the bulls want a high two pullback, opening reversal up from support, the top of yesterday's range, and then Tuesday's low. And the bears want 2 bear bars, 3 bear bars, and they want to go outside down. Yesterday's a small day. That increases the chances that today will be an outside down day. Also, we have 3 dojis, so a lot of trading range trading. That further increases the chances that we can go outside down and trade below yesterday's low. Right now, I still think it's more likely that we're going to try to get up to that major lower high on the 60-minute chart, this high over here. We have the minimum goal. We have a bull trend, bull flag, and a bull breakout. So the bulls have achieved their minimum goal. What do you need to buy above 3? The bigger the bar is, the more willing traders will be to buy above it. Right now you have limit order bulls who bought the 1 low, and they bought more 1 point lower, or they did not buy the 1 low, and they simply bought 1 point lower. They're trying to buy 1 point lower, and they need the market to get back above the 1 low. They did not. This has not fallen 1 point below 1, so nobody could buy 1 point below 1 yet. But at a minimum, the bulls who bought the 1 low, who are disappointed by 2, some of them will try to get out, break even at the 1 low, and they need it to get 1 tick above the 1 low to get out. Okay, that is a high 2 buy and a reasonable buy. Are we always in long or always in short? Well, we were always in short yesterday, and the bears did not do enough to, we're always in long at the end of yesterday, and the bears did not do enough to make it always in short. This is a reasonable swing buy, but, we went up, we went down, we went up, and the bars are big, so the risk is bigger, and then we have big reversals today and trading range trading yesterday, so the probability is less. So this is warning us that today might again have a lot of trading range trading. What happens if it's a bull trend day and you do not buy right here? Well, in fact, I did not buy here. I thought about buying, but I decided against it because of the size of 2. If it's going to be a bull trend day, it will become obvious at some point, and then the probabilities get higher. That's a micro double top, up on 1, down on 2, up on 3, down on 4. So it's a second failed breakout of yesterday's high, but really big bars. So the risk is big, and you have a trading range day yesterday and a lot of reversals today. So the probability is less. So this is not good stop entry trading. Buying above 1, buying above 3, selling below 2. This looks like more of a limit order open. And now the bulls will try to get a wedge, a high 3. Okay, so this is a wedge. 3 pushes up, 1, 3, and 5. And even though it's a limit order market, of the 3 buy signals, this is the one that has the highest probability. I still think the odds are we're going to try to go higher, that we're going to try to get up to Tuesday's major lower high. tough buy above 4, but unfortunately that is the buy signal. Sometimes I'll pop up usually not, but sometimes I'll pop up a lower time frame chart. Here's a 3-minute chart, and take the signal on the 3-minute chart, but I usually do not do that. I prefer to stick with one time frame. And because of the multiple reversals, even though this is a reasonable buy setup, I did not buy above 4. So right now I'm trapped out. I'm bullish. I think it's always in long, and I think we're trying to get up to that 60-minute target over here. So that's where we're trying to go. Whenever you see buy and sell setups that just don't look right, either the signal bars are bad or the signal bars are good and they're too big, it increases the chances that the day is going to have a lot of trading range trading. So buying above 4, a bad looking buy signal bar. Selling below 2, a very big bar, so big risk. Both of those things are warnings that today is going to have a lot of trading range trading. We're still always in long. The bears never went always in short, but not a great buy setup. Buying at the top of a 5-bar tight trading range where every bar has reversed the previous bar. What happens if 6 is a bear bar? I think we're always in long. I think this is an opening reversal up from a test down, a test of yesterday's high, test of Tuesday's low, test of the moving average, and therefore I think probably buyers below 6. Let's say it's a bear bar closing on its low. Would I sell it for a double top? I would not sell it. But it's really not a great looking buy either. But it's slightly more bullish than bearish. While I didn't check the measured move projection, you can guess where the measured move projection will take us. Right, we have an important target above. Let me slide this down and see. No, it does not get us up to last week's high, but it does get us above that 60-minute major lower high from a few days ago. The market is telling us that today is probably not going to be a strong trend day up or down, and that it will probably have a lot of trading range trading like yesterday. Can you buy here? Let's say we got a bull close. Can you buy and put a stop below 6? I don't know. I think we're always in long, but I think it's very difficult to structure the math. We're getting a lot of reversals and a lot of big bars, and that makes it very, very difficult to structure a reasonable trade, long or short. I would definitely not sell below 6, even though it's a double top. But we're at the top of a 6-bar range that has reversed on every bar has reversed the prior bar. That is not how strong trends typically behave. So bullish, but not not easy to trade. We're at the major lower high. Should get above it. The bears want the double top, but this reversal is so strong that we should go higher. It's doing this because everybody's buying the market, Whether they swing trade or scalp, I don't know. We're very close. Well, we're already at the measured move target. I tend to scalp when I think the day is going to be mostly a trading range day. What are the chances that this breakout could fail? You know, if every bar is alternating, every bull bar followed by a bear bar, what's the chance that 7 is going to be followed by a bear bar? I don't think it matters unless it's followed by a very big bear bar. Chances are we'll get at least one more small push up. Big tail, a reminder that a big bull trend is not likely. One of the things that is a problem with one of the brokers that I use is I click on the order and the order gets filled, and then I notice that for some reason it read it as a double click, so I end up with a position twice as big as I want, and that happened here. And when that happens, whenever there's any kind of mistake, I'm usually quick to get out. So I end up getting out, and I made a profit, and I made more profit than I would have made had I traded my normal size position. But because it's not what I wanted to do, I was unwilling to hold it to the target I was trying to get originally. But that's one of the things, when you think everything is, by the way, I also bought the euro looking for a scalp up. But anyway, there are all kinds of little problems with all the different brokers. There are other brokers I use for different things, and there are all these little things to remember, and it's hard to remember all of them. And sometimes I make mistakes, and but when I make a mistake, usually what I do is I just get out, because if I try to spend a lot of time trying to figure out the best way to get out, I often end up compounding my mistake and losing more money. So whenever I make a mistake, even if it's a mistake that's good for me, like today, I still am very quick to get out, because if the risk is more than I want, I got to reduce my risk, and then I make a decision on what to do next. Bulls have the minimum, the minimum that they want, consecutive bull bars, even though the second one is only a one-tick bull body, and the first one, bar 7, has a big tail on top. That makes the odds slightly higher that we're going up at least a little bit more, and therefore probably buyers below 8. We know the first 6 bars limit order market. We know there are bears who sold the 6 high, and they're scaling in higher. And they're hoping to get out. And we know the bulls are hesitant to buy too high, and the bulls are probably scalping, so they're selling to take profits. That increases the chances that we're going to get down to or close to the 6th low. Once there, the bulls will buy just above the 6 high. Once we're there, the bulls will buy just above that 6 high, trying to trap the bears and forcing the bears to buy back their shorts higher for a loss, and also give up selling. And the bears are selling here, trying to drive the market back below their first entry price at the 6 high. So this is important information over the next few bars. Will the limit order bears who sold the 6 high and scaled in higher make money? If they are successful, that reduces the chances that today is going to be a big bull day, and it increases the chances that today will probably be mostly a trading range day like yesterday. Do I think today is going to be a big bull day? There are some major targets above, but I don't think it's going to happen. We got last week's high. We went outside down, and now we're trying to go back above last week's high after going below last week's low. And the bulls are therefore trying to make the week outside up as well, and we're very close to an all-time high. Weekly chart, every week, or almost every week, is closing at a new all-time high, and the bulls would like that again today. Bears want the failed breakout. They know 8 is a bad signal bar, but if they can get 9 to be a bear inside bar closing on its low, they then would have a better sell setup. I think a lot of the bulls, if they're still long, if they're swinging apart, they'll get out below 9 if it closes on its low or only has a 1-tick bear body, even though still probably buyers below. I talked about this yesterday. When you get a strong move up and you get a bear bar closing on its low on the open, it's better to get out of longs, and a lot of bears will sell. When you get a strong move down and then a bull bar closing on its high, it's on the open, it's better to get out of shorts, and a lot of bulls will buy. So those signal bars in the first hour are important. This is what I was talking about. We have a bear II, we have an II, and the second bar is a bear bar closing near its low. While the odds are buyers below, a lot of bulls will get out below 9 just in case we get a series of bear bars. Some will hold long and put their stop below 4 or below 6 or 7. But with all of the reversals today, a lot of the bulls are extra cautious. Can the bears sell below 9? I would not do it. I think it's more likely buyers below, but it's a possible high of the day, and therefore it's a legitimate, reasonable swing sell. I would not do it. I would wait for a second entry short or for 3 consecutive bear bars. II, so it's a bull flag, but big tail 7, doji 8, bear bar 9. Yes, it's always in long, and it's a bull flag, but a lot of traders are being cautious, right? This is not the way strong bull trends typically look, and therefore it's probably not a strong bull trend, even though we have reasonable targets just above. In particular, last week's high, the bulls really want this week to go back to outside up. We're outside down, traded above last week's high, and then below last week's low. So we traded below last week's low, and now the bulls are trying to get back above last week's high. So they're trying to convert it into outside up after being outside down. Last week's high is close to the measured move target, and I think it's a much more important magnet, so I'll just leave that. And this is that 60-minute major lower high. And we're above it, but I think the most important price right now is last week's high. So I'll leave it because we may end up oscillating around this. No, I'll get rid of it. Too many lines. If you buy above the II, stop typically below the II. However, because of all the reversals, there's probably a 50-50 chance that if it goes above 9, it then soon afterwards goes below 9, and the pullback becomes more complex. So instead of a high 1 bull flag, we could trigger the high 1 and then immediately reverse down and get a high 2 or a wedge bull flag. We still have a magnet here. So this is not a great buy. Disappointing, right? Plus, all of the reversals here are trading range price action. So while the odds favor higher, they do not favor a lot higher. I don't know if my mic was on. Can the bulls put a stop below the 7 breakout? I think if you're willing to put a stop below 7, you're probably better off putting it below 4. So instead of below the breakout, below the entire bull leg. I am back to flat. If we get a pullback down to around the 6 high and reverse up, especially if it's a perfect breakout test, that would be a higher probability buy. Market often has these perfect breakout tests. This was not perfect. It fell a tick or so below the breakout point. Here's a perfect one. Pull back to the top of the triangle. Did not dip below. A lot of times they'll lead to measured moves up. So here's a perfect breakout test. Exactly to that high and reverse up. So that's a fairly high probability buy. You can see the disappointment, right? Always in long, but the risk is big. All the way down here. And for the bears, a possible second leg trap. Leg 1, pullback leg 2, but the probability still favors the bulls. I want more information before I place another trade. We're getting near the end of the first hour. 60-minute chart. What do you see that looks like important? Looks like an important price. The major lower high. And the 60-minute bulls are trying to close above that high, and the bears are trying to get the close below that high, hoping the breakout fails. The bulls would like the first bar to close on its high, and then they'll have a better chance of getting a new all-time high. But it looks like we're going to probably close the first hour right around this high, maybe a tick or two above or a tick or two below. Amazon, they've badmouthed it for years on fast money. And, I think it's a great company. And here it is today, huge gap up. Google, huge gap up. Let me see what else is interesting. Facebook, Microsoft, look at Microsoft, incredible. Since Steve Ballmer retired, here's Steve Ballmer. We had a decade of Microsoft doing nothing, and then he retires, and Microsoft is tripling in value. So Steve Ballmer leaves, as a multi-billionaire doing a horrible job as CEO. And now he's even richer because I'm sure he still owns a lot of Microsoft stock. And he's making a lot of money off the guy who is doing the job correctly. First Solar, and put up the daily chart. Another strong day. We're in earnings season, so I'm just taking a quick look at stocks. Intel, extremely climactic. Do you think this is going to continue up like this? No, because bulls will take profits. They have a windfall profit, a huge profit, and they don't want to risk giving any of it back. So you get profit taking, and instead of going straight up, you start to go sideways or even pull back. All right, so bears trying to get their reversal, and will we dip one tick below the 6 high? Can this be the high of the day? It can be the high of the day, but I think more likely it'll be like yesterday. If we get a sell-off, it'll be a bear leg in a trading range. So I think the bulls have a slight advantage. It's interesting, it did not even trigger the buy. We had a high 1 after bar 8, and then we had an II, and then we had an III, and with 2 bull bars, and there were just not enough bulls trying to buy with stops above 10, and there were too many bears trying to prevent the buy signal from triggering. They're trying to get the market below the 6 high. You can sense the disappointment, right, for the bulls and bears. You can sense that you want it to get going. You want it to start trending up or start trending down, and it's not doing it. The reason it's not doing it is no one feels the price is terribly wrong. The price is just about right, and that makes traders resistant to selling. Resistant to buying too high. They want to buy pullbacks. So this is what I was talking about. I would feel the probability buying above 12 would be higher if we triggered the high 1 first. This would then be a second entry buy. Is it a high 1 or a high 2? Well, on this chart, it's still a high 1. Getting near the end of the first hour. Remember I said that the bulls would try to get the hour to close above that major lower high on the 60-minute chart. It is at 70 and a quarter. You can see we're just deciding in the final seconds, are we going to close above 25.70 and a quarter, that high? Bulls failed to close above the key resistance level, and the 60-minute chart is on bar with prominent tails. So for the bulls, a high 1 above 12, but 3 bear bars in the past 4 bars. A lot of bulls will not buy above 12. The bears want a third consecutive bear bar, and that's why the bulls will buy the close of 12, trying to prevent the bears from getting a bear bar. Also, if 13 is starting to be a bear bar, in the final minute, the bulls will buy, trying to turn it back into a bull bar. They don't want the bears to get 3 consecutive bear bars, and they certainly don't want the bears to get below the 6 high. By the way, on these huge stocks, Alphabet, Amazon, Facebook, Microsoft, you have to bet that there's going to be some profit taking. And that's consistent with what I'm saying about the extreme buy climaxes on the weekly and monthly charts. Also, buy climax on the daily chart as well. Let me turn the screen off for a moment and open up that examples folder. I saw this chart on the internet. I think I showed it yesterday. Monthly chart for 90 years in the stock market, S&P 500 for the past 90 years. And the height of the yellow bars is the number of months since a 3% correction. And this was the longest ever without a 3% correction. The market went 12 months without a 3% correction. And in terms of days, this was 241 days. This was 241 days as of last Friday, so this is 5 more days without a 3% correction. So this is the longest in the history of past 90 years without a 3% correction. You can see there are no yellow bars here. That means the market could not even go 1 month without a 3% correction. So back here, every month had a 3% correction, and that was the way for more than 20 years. So 3% corrections were normal. Even through here, we went many years with 3% corrections occurring at least every month. That chart is not, I don't think that's my latest version of it. It makes me think that that we're not syncing properly between my two computers. Okay. So that's the high one buy, but I'm not planning to buy it. Always in long, yes, but we're getting close to the 6 high magnet below, and now we're in a 6 bar bear micro channel. So I'm going to wait. I want to check if this is syncing properly over here. second entry buy, so slightly higher probability, but always in long, but obviously a problem, right? We're not as strongly bullish as the bulls would like. Can you sell here, betting on double top 10? I would not. And suppose the bears get the double top and get a decent bear bar 16. What about selling? I still probably would not. I would want the market to go sideways more here. Bears trying to create the double top, but I think the odds are we're going higher. The low of last week is a really important magnet, and I think we're going to try to get there. I'm going to turn the screen off again and try to open up that examples folder. I think I've fixed the sync problem. Nope, did not. Let me delete that folder or that file. And I'll give the sync a little bit more time to work synchronization between the two computers and the cloud. All right, so for the bears, now they have a double top lower high. It's all tiny, but let me take a look at a 1 minute chart. Maybe it's more obvious. So for the bears, they have a tight trading range with the double top. On the 1 minute chart, if you have a tight trading range and a bull trend and a double top, it's a major reversal, and therefore it's a realistic sell. Looking for a major trend reversal on the 1 minute chart. A major trend reversal on the 1 minute chart is usually just a bull flag on the 5 minute chart. 5 minute chart still always in long, but you can see it went up 6 ticks and stopped. That tells you that a lot of the bulls who bought 15 are scalping, and if they are scalping for 1 point, they are not confident that we're going up for a swing. The bulls want a slightly higher high double top, break below the neckline, measure move down. The bulls want this to be a breakout of a bull flag and 17 to be a pullback and for the trend to continue higher. The odds still favor the bulls. I think last week's high is a very important magnet. I'm going to take a look at the examples folder again. Lower high, but not enough bars for a major reversal, so it's a minor reversal. Still always in long, and lots and lots of sideways bars. Sideways here, and then here, and then here, and then here. Reduces the chances of a big bull trend, but still always in long and still getting drawn up to that magnet above last week's high. So buyers or sellers below 18, probably buyers below. For the bulls, this II is a pullback from the 16 breakout of this bull flag. The bears want the double top break below the neckline and reversal back below the 6 high. Slightly more bullish than bearish, especially since I think there's a very important magnet above. The bulls are so close to having the weekly chart go back to always in long that they probably will get closer. I don't know that they'll be successful, but I think they'll get closer to last week's high. We're so close now that we probably have to get closer. Is anyone going to sell below 20? Probably not. Bears might sell the 7 high, but we're so close to last week's high that the odds are we're going at least a little higher. I think bulls will take partial profits around last week's high, maybe a tick or two below. They might wait to see what the breakout looks like. If it is a series of strong bull bars, they might hold apart. This could be one of those wedges that doesn't look like a wedge. So 1, 2, 3, but with now about 9 bars, 8 bars in a bull microchannel. Most bears will not sell the first reversal down. Can today be one of those huge days that just keeps trending up, forming gaps? We have a gap here. Bulls trying to get a gap here. Well, it's always possible to be a small pullback bull trend, but I think the bulls would be satisfied with having the week just get above last week's high. We're very close to an all-time high. So even if they get the all-time high, that still does not require a huge bull trend. It just requires another few points up. I want to take a look at that examples file again to see if it has synced. Sometimes OneDrive just has these sync problems, and you just have to wait for it to resolve. Nobody's going to sell below 21, so we're probably going at least a little bit higher. The bears will probably need at least a micro double top. Anyway, this is that slide that I was showing. This is a daily chart. This is a monthly chart going back 90 years, back to before the Depression. This is the sell-off at the Depression. It's logarithmic, so it does not look like a normal chart. This is a 90% correction, even though it does not look like much. And this is a 50% correction, another 50% correction, even though they look tiny because of the log scale. Vertical axis is months. This is 12 months. This is 12 months. And it's the number of months that the market has gone before having a 3% correction. This was the longest in history, at least a 90-year history. It went 12 months without having a 3% correction. And it turned down because then it had a 3% correction. It's a monthly chart, so a 3% correction is invisible. Remember, this is a 50% correction, so you don't see 3% corrections. The correction actually occurred at 241 days. It finally got its 3% correction it finally fell 3% on the 241st day. You can see this yellow bar is the same height as that one. That means this is also currently 12 months without a 3% correction. What's different is it was 241 days as of last week, and now we're 5 days longer. So even though the spike is the same height, it's actually more days. This is the longest the market has ever gone in history without a 3% correction. This is 241 days, and this is 5 more days. So right now it's 246 days without a 3% correction, and the market has never done that before. You can see there's a long stretch here with no yellow spikes. That means the market could not even go 1 month without a 3% correction for 20 years. And then here, about 7 or 8 years. And then here, the market couldn't even go, 1 month without a 3% correction. And during this entire 10-year stretch, the most it could go without a 3% correction was just 2 months. Yet now we have the longest streak in history without a 3% correction. And that means this is extreme and unsustainable on the daily chart. Remember, it's the most days ever. Right now, it's not the most months. It's tied for the most months, 12 months, without a 3% correction. But the number of days within those months, this yellow spike, even though it's the same height as this one, in terms of months, this has more days. So this is the most overbought on the daily chart in 90 years using this measure. And then we already know that the monthly chart is 12 months without a pullback. It's only done that once in the past 50 years. And the weekly chart is now 49 months without a pullback to the moving average. And the E-mini has never done that in the 18 years of the E-mini. So we have extreme behavior on all time frames. And it can always become more extreme. However, it's unlikely to become much more extreme, and it's probably going to have some regression toward typical behavior. And that's why I think we'll get a pullback. I'm talking 3% correction, which is about 75 points. More likely and it would also get us to the weekly moving average. 75 points down would get us to around the weekly moving average. Right now it's about 100 points below, but it's rising. So if we pull back for 2 or 3 weeks, this will be around 2,500. So 75 points down, 3% down will get us there. But I think more realistically, we have to get down to this high, the August high, because this pullback just was not enough of a test. It's only a little doji and only a little dip below. Usually that is not enough of a test, and the breakout point will have to get tested again. So that's another reason to think that we're probably coming down here, and that would be about a 100-point correction. So about 5%, about 100 points. All right, nobody's going to sell below 21. It's bad follow through after the 2-bar breakout. We're within 3 ticks of the target. Usually when you get within 3 ticks of such an important target, you're going to get closer. Usually you have to get within 1 tick, or you end up keep going up far above the target, but usually it will not reverse down until it gets at least 1 tick to the target, to within 1 tick of the target. For the bears, it's a type of a wedge. We've reversed down 1 time, reversed down a 2nd time, and then one reversal down a 3rd time. But with a 10-bar bull microchannel and with a magnet 2 ticks above, probably buyers below. It's a low probability sell. For taking right there, right, which is reasonable. For bears scaling into shorts, we have a gap here, we have a gap here, yes, we have a wedge, and it's a nested wedge, 1 pullback, 2 pullback, 3, but it's also a 12-bar bull micro channel and a small pullback bull trend, and the bears are not making money over the past 12 bars or so, so it's still too early, I think, to sell. Trying to get to a new all-time high. The most important price, I think, is last week's high. You know, the bulls would like the week to close above last week's high. I don't think it matters all that much if they close at a new all-time high. I think the major accomplishment is that the market went outside down on the weekly chart, and it's finishing the week outside up. I think that's more important than anything else. We're getting gaps, but we're also getting climaxes. And usually if you're getting climaxes, the trend is less likely to last for the remainder of the day. The gaps are good. You know, gaps make you think of a small pullback bull trend, and which could last all day. But the buy climaxes, gap up, gap here, here. I think that reduces the chances that we're going to go up all day, and it increases the chances that we'll probably have to go sideways before long. This is a fairly climactic version of a small pullback bull trend. We're not quite as strongly bullish as this, but you know, even the bull bars here are not all that big. You know, see, we have smaller bars here, and when you get the smaller bars, the trend can go a lot longer. When you tend to get a lot of bigger bars, it tends to be much more of a consecutive buy climax type day, and usually results in a trading range. Usually it gets exhausted and has to go sideways. This is kind of like today. Usually gets exhausted and has to go sideways. Consecutive buy climaxes. Here did not matter. It went up a long way all day long. This is unusual. Again, this is unusual where you get all day. You can see it ended up with a parabolic wedge top and then a big reversal. More likely you go sideways for an hour or two before long. Still impossible to make money selling. So whenever it's impossible to make money selling, it's usually good to buy or to get long. And because of the parabolic wedge or the consecutive wedges, if you buy, you have to be using a wide stop. I think it's probably too late to buy it. If you have not already bought, I think it's too late to buy because we have a parabolic wedge inside of a bigger wedge, 1, 2, 3. So chances are we're going to get a pullback soon. With the parabolic wedge top, you know, we might be putting in the high of the day, but I think it's too early to sell. Most parabolic wedge tops do not lead to bear trend reversals immediately. If they do lead to a reversal, usually the market has to go sideways for 10 or more bars into an endless pullback. Parabolic wedge, had to pull back here, you had to get a pullback here, pullback here. This is more like what I'm talking about. Usually you have to enter a tight trading range that's sloped slightly down for 10 or more bars. And even then, you only have a 40% chance of the bear breakout and reversal down. See many other examples, right? sideways, went sideways to down for 30 or 40 bars. More often, it becomes a bull flag and you get another leg up. 10 or 20 bars sideways to down and one more leg up. When you get that one more leg up, usually it's the final leg, and this becomes the final flag. Here, one more leg up. Climactic, tight trading range. So probably for the next 5 or 10 bars, or probably within the next few bars, we'll start to enter a very tight range. I think it's a little bit difficult to make much money buying right here. I think it's probably better at this point if you're not long, or if you have not already, if you're not, I think it's better to wait to buy. And I think while it's possible to make money selling in a small pullback bull trend, that's a bad strategy. It's a losing strategy. Where have the bears made money? They're losing on everything, right? And if the bears cannot make money, it's bad to sell. Chances are the market has to go higher, or at least sideways. So the downside risk is not great. Within a tick of the all-time high. While I think we're probably not going much higher, look at the pullbacks. The biggest pullback was about 5 ticks in an hour and a half. So, I think not very good shorting, even though I think we're not going much higher. This might end up as the high of the day, but I would rather wait until we start to get some bigger pullbacks before thinking about shorting. And right now I've stopped buying and I'm looking for a pullback to buy. But a lot of times the market just goes sideways after a parabolic wedge. A move to a new all-time high, I think, is consistent with what the major stocks are doing. Even Apple is up. And Apple, Alphabet, Amazon, all strongly up. Facebook, Microsoft, everything is way up. Twitter, everything is looking so good. So it makes sense that the 5-minute chart would be up as well. Now, what about the first pullback? Will bulls buy the 28 low, 29 low, or will they wait for a second entry buy? Well, one of the problems right here is the bars are small. We're clearly very bullish, very always in long, but we have a parabolic wedge and small bars. So a trader buying the 28 low, for example, he needs it to go up 5 ticks to make a profit, and that means it has to get above the 28 high. I think he will make a profit, but it's so climactic that right now I'm going to wait maybe to see if we get a couple bar pullbacks, see what we get. Again, selling this, I can't do it. I can't sell. So it's either buy or wait to buy. What are the chances that this is the high of the day? I would say 30%. I think the best the bears get is a endless pullback or a tight trading range. So not much downside likely. And the bars are small, and that makes the bulls hesitant to buy the 28 low because it has to go up 5 ticks, and that's the entire height of bar 28. Can't we just simply pull back endlessly after a very tight bullish channel? Not likely. You can see here it's significantly less bullish than today, and we reversed. We have 4 bear bars. Even then, we still went to a new high. So this is probably the best the bears could hope to get. I don't think they're going to get 3 consecutive bear bars right here. I think the best they'll probably get is a tight trading range. It might be sloped downward a little bit. I'm going to try to open that examples folder again, see if it's completely synced. Every now and then, cloud drives have problems. I use Amazon, I use Google, I use Apple, I use OneDrive, and sometimes you just get sync problems, and they just seem to go on forever. Breakout to new all-time high. Limit order bulls who bought made money. I don't know if most of them will scalp. I think scalping is probably the better thing to do than to hold for a swing. And stop order bulls, 30. You see what's going on? They buy above 30. They needed to go up 6 ticks and went up 5 ticks. So right now the stop order bulls might be getting trapped, and that increases the chances that we're going to start to pull back. They're not trapped yet, right? But they might get trapped, and if they do get trapped, then we'll probably start to get a pullback or a tight trading range. Let's say we get a reversal bar here. I still think you cannot sell. Unfortunately for me, I did not hold, and I'm flat, and I want to buy a pullback, and I'm trapped out, and I am not buying the close up here, so I'm stuck waiting. I talked about a possible leg 1, leg 2 move. We might already be beyond that. So maybe leg 1 here, maybe leg 1 here, and then leg 2 there. And we're just about to that. If this is the end of leg 1, then we're almost there. If this is the end of leg 1, which I think is the case, then we're already beyond the measured move. Sometimes you get leg 1 and then a trading range, and the top of the trading range is above the top of leg 1. Some computers will say this is the top of leg 1. Others will say this is the top of leg 1. In any case, we're in the neighborhood of the leg 1, leg 2 measured move. However, without pullbacks more than just 6 ticks, it's impossible to make money selling. So it's still by the close, but right now it's too climactic for me, so I'm trapped out. I do not even want to sell with limit orders, right? It's just the pullbacks are too small. So usually that means the downside risk is very small. The bears would first have to convert it into a trading range or a pullback before traders will start selling. Doesn't matter if it's a buy climax. The bears will not make money even with limit orders. And I want to see them make money with limit orders before I consider selling. I got to work on my synchronizing again. For the bulls, an inside bar, so a high 1 buy and another gap, 33 low, 28 high. I'm going to wait to buy. Another II, bull flag, but musical chairs, right? Chances are this is not going to continue and it will start to enter a tight trading range, but until it does, the odds favor higher prices. I don't think we're going much more up without pulling back, but we have a gap, we have a gap, and we have a gap, another gap right here. The market achieved its goal. It got above last week's high. Here's the weekly bar. Can the bulls get a big bull body this week? Probably not. And outside up is any outside bar is a trading range type phenomenon, and that usually results in a trading range looking bar, especially since we went down and up. Chances are the week will close around the open, which means chances are we're going to close around last week's high. Actually, the open of the week is it's really interesting. Remember on Monday we opened on the high tick, and I said that is really, really unusual, and for it to stay that way. And today we went above it, so the market has taken away the magnet up here. It took 5 days to get back above the one high, but it did, and I think that increases the chances that it's going to be a magnet all-time high and open of the week. So it's even an additional reason why we'll probably have a hard time going much higher, and it increases the chances that it's going to be a magnet for the rest of the day, and that we're probably not going to go very far up or down for the remainder of the day. And whether we go up or down a few points, we'll probably come back and test the blue line in the final half hour. Buy climax 31.30, 31.32, and not enough traders willing to buy up here, so we may start to pull back. It's just extremely climactic, and it's a buy vacuum test of resistance. I think the open of the week is really important. I said it at the time that only 20% of the time, if a day opens on the high tick, will that high remain the high of the day. And this was that 20% of the time. It opened on the high and never went above the high. And on the daily chart, the open and high were the same price. And that's really unusual. And the market is testing above that price right now. And I think that it probably will be a magnet for the rest of the day. It's also around a leg one, leg two measured move up. Let's say that's leg one, and leg two starts here. It's exactly a leg one, leg two measured move up. So that's another reason to limit the upside from here. I think we're probably going to do this, for the next couple of hours. I think this is probably it for the rally. The odds of a big bear day from here, usually that would be very rare when you have a micro channel like this with that many bars. Big micro channel trying to get a reversal down. Best the bears get is that. This is the monthly micro channel. Micro channel for a lot of bars. Market had to go sideways for about 10 bars. It pulled back ultimately, and I think this will be similar to today, that if we do get one more push up, we'll come back down and close the week around the open of the week. Bull micro channel. Bears tried to reverse down a couple times, could not do it. 60-minute charts, strong bull micro channel. The bears got a little bit of a reversal, but could not get very far down. But I think this is probably what we're going to get over the next couple of hours. Now, I said two things. I said I thought we would stay around the open of the week, the blue line, for the remainder of the day. And that we probably would be mostly sideways in a fairly tight range. Buyers below at the moving average, sellers above. We may not get any higher because we reached the leg one, leg two measured move target as well. I've been saying for the past hour that you can only buy. If bears cannot make money, you have to buy and you can only buy. And then at some point, you're going to be thinking consecutive buy climaxes and an exhaustive end of the move. And we're at that point now. Now, can bears sell now, like above the high of the day and above 36? They probably can, but I still think it's better to only be buying because of just how strong the bull trend is. Can you buy right here and scale in lower? Yeah, but you might have to risk a few points. You may have to risk 3 or 4 points somewhere down here. We have a spike pullback channel, and this is an exhaustion move. It's the biggest consecutive pair of bars since here, and it's also a parabolic wedge and a possible small final flag. A lot of times parabolic wedges have small final flags before they start to correct. 1 bar final flag and then exhaustion bar and then this. Small final flag and then exhaustion and then tight trading range. Here we got some trend resumption up and we might get that today, but like here, we'll probably come back down to some key price, and today that is the open of the week. So a little pause and then a climactic end and then sideways for a couple of hours. When you have a buy climax, the market usually tries to get down to the bottom of the buy climax, the 31 low or the 30 low. And also we have a 20 gap bar buy. In fact, we have not hit the moving average since bar 80. So right now that's a 39 bar streak above the moving average. However, if we get to the moving average, probably buyers below. I think this is it for the day. We may go a few points higher. We may go sideways for an hour. I think this is probably the template. You go sideways for an hour and then bull breakout. It fails and then back to the key price. Can the bears sell? Still better to be a buyer, but I think we're probably in a tight trading range and bears probably will start selling. Very little money to be made as a bear, and it's going to be very difficult to make money as a bear. Right now, it's probably going to be very difficult to make money as a bull or a bear because we're probably going to be sideways for at least an hour, maybe a couple of hours in a very tight range. How much higher do we go? Probably not much. I think we're in a tight trading range. Still getting little gaps, the 35 low and the 28 high. So it makes it difficult for bears to make money. But will the bears make money? Although I have not shorted at all today, the bears probably will start doing it. I'm not willing to do it yet. You can see as soon as you get the doji closed, look at the open of 41, 1 tick below 40. So some bears, as soon as they saw the doji close instead of a bull body, they sold at the market. So that means bears are starting to sell and they're starting to scale in higher. Can you buy the 40 low? I would not. I think a trading range is likely. The bulls are hoping that this is a bull flag, a breakout, and a pullback, similar to this. Bull flag, breakout, pullback, and the bulls want the market to keep going up. Small bull flag, breakout, pullback. Bull flag, breakout, breakout pullback. I want to buy lower. I want to buy around the moving average, maybe the 30 low, maybe the 36 low. So I would not buy here. And for selling, I don't have strong feelings. You might have to risk 4 points or something and scale in higher, but I still think it's better to be looking to buy pullbacks than selling rallies. Starting to form a tight trending range, probably will last for at least an hour or two, maybe 11:30. As I said, it's similar to this day, and tight trending range. We got one last rally, and then a pullback to the support level, which is where I think we're going to end up. I think we're going to end up right at that blue line, within a point of it, up or down, the open of the week, because the bulls have achieved their goal. They just wanted to get back to outside up. And beyond that, they don't really care if it becomes a big bull bar. They just wanted to get above last week's high. And that's the goal. I don't see any other obvious goals above. Can the bears start selling with stops, given that they might, they're starting to make money with limit orders, selling this high. It fell 5 ticks, which it had to for the limit order bears to make money. The bears have sold this close, got filled 1 tick lower. They have not yet made money, but I think we're probably in a tight trending range, and I think the bears will start making money. I would not sell with stops yet. Probably buyers around the 35 low. The bulls try to get a double bottom. Buyers around the moving average. Buyers around the 30 low. Is this a higher high major trend reversal? No, it's not major. It only went up 3 or 4 bars, down 3 or 4 bars. That's a minor pattern. Major pattern, you need a bigger pattern. You need maybe 10 bars up, 10 bars down. Anything less than the best the bears get usually is a bull flag. Probably will bounce at the 36 low. It's a double bottom around the moving average. Do I think we'll fall below 36 at some point today? Yes. I said the market probably is going to oscillate around that critical price for the remainder of the day. And then at the end of the day, the bulls will decide whether to close above last week's high or above this week's open and get a bull body, or below both. Right now, unless the bears start to get a lot more selling, the odds are we're not going to fall very far. Well, the bears, they ultimately want a reversal down here, spike, pullback, channel. They probably will need either of two things: a tight trending range, more bars, and some kind of a double top or some kind of major trend reversal in the tight range, or a tight trending range that has 2 big bear bars breaking out to the downside. That's those are the 2 ways that parabolic wedges typically reverse. Big bear bar, pull back to the moving average and could not rally, and a couple bear bars, and that led to a big sell-off. Unlikely that we'll get this, right? More likely we'll form a tight trading range and try to get one more push up to a new high. I don't know if we get the push up to a new high, but right now I think it's most likely that we're going to close right around where we are. We'll probably get at least one move below or one move above before the end of the day, but probably get back here. Unlikely that we're going to go a lot higher because the bulls have achieved all their goals. There's a possibility we could go a lot lower, but right now the chance of that might be 30%. If we start to break to the downside, it becomes 40%, 50%, 60%. But right now it's only a 30% chance. I was just watching time and sales because the market was having a hard time getting down to the moving average and the 36 low. And when it did, there were two trades that took place. One was 690 contracts, and immediately afterwards, there was one for 750 contracts. Again, you never know if the time and sales are correct, but it was interesting that it was all, small trades, and then suddenly it went one tick down to the 35 low, 36 low, and the moving average, and there were suddenly two big trades, about 700 contracts, each, each within 1 second of one another. So it's probably one trade for 1,500 contracts. As I look at it, it's 693, then 48, and then 750. So those three things were consecutive and within 1 second. So it was probably a 1,500 contract trade. And you never know if it was buyers or sellers who initiated the trade. Afterwards, if it goes up, then it was buyers, and if it goes down, then it was sellers. Bull's trying to get a double bottom bull flag, and it's a small high 2 with 42. It's an okay buy, but chances are we're more of a limit order market, and we're probably not going very far up or down. What happens if we break 2 ticks below 36? Then we'll probably get down to the 30 low. The bears need 2 big bear bars, not just one bear bar. They need consecutive bear bars, usually to get a significant reversal. Here we got 3 bear bars. Odds are they will not get it, but if they get it, then we're probably going down. Bears trying, right? They need consecutive, decent sized bear bars to reverse this to short. Probably will not get it. Probably will stay in a tight range. I was just looking at stocks. Google getting a big tail, and Microsoft, Doji. Monthly chart of Microsoft, a tight bull channel, and getting a huge bull breakout. Extremely climactic. Bulls are hoping that this is the start of an even stronger bull trend. So bull breakout, pull back, and then channel up from here. I don't think that'll be the case. This is a monthly chart. It's good for the bears that they got a couple ticks below 36, but we're still always in long. By going a couple ticks below, it increases the chances that we'll get down to the bi-climax low, the 30 low. We got to within a tick of 31. It's still a high 2, high 1, high 2. Some traders will see it as a wedge. 1, pullback, 2, pullback, 3. But trading range, traders are going to be looking to sell rallies and buy pullbacks, and a lot of it will be with limit orders, buying below bars and selling above, selling up near the top of the tight range. The bears need to do more. This is not enough. Too low to sell, especially when we do not have a major reversal. I said that we might get an endless pullback sideways to down for 10 or 20 bars. That often happens after a parabolic wedge or any kind of a biclimax. Even when it happens, only 40% chance of this, 60% chance of more sideways or up. Still always in long, we have a high two bull flag, a small breakout, and a pullback, similar to this. But now it's different. I think now, even though it's a 20 gap bar buy, probably the best the bulls get is a tight range here. And a lot of the bulls are only buying with limit orders at prior lows rather than with stops above bars. And bears will start selling around the top. The reason we're hesitating right here is it's 5 ticks above the 36 low. And bulls bought with limit orders at the 36 low. And now they're scalping. And so we're stalling 5 ticks above. That's exactly where the market had to go for them to take profits. And that shows you that the bulls are buying with limit orders and they're scalping. That means they're not confident that the market's going a lot higher, and therefore we're probably going to stay sideways more. Whenever there's a tight trading range in a bull trend, you have to be looking for some kind of reversal, and often gets a double top, lower high, major trend reversal. So we have a lower high here, bears trying to get back there, and they'll try to get a double top if we get there. This is strong enough up so that probably buyers below and a little bit more up. However, let me see if I can find it. Strong bull trend, double top in a tight trading range, 2 legs down. Strong bull trend and a double top in a tight trading range, a couple of small legs down. Bull trend, not very strong, tight trading range with a double top. Here we only got 1 leg down after the double top. Strong bull trend, double top, only 1 leg down, no clear second leg down, maybe this to a higher low. I should put that there. Tight trading range with a double top, but not after a big bull trend. Other examples, tight trading range, double top, tight trading range, double top, tight trading range, small double top. Now it's the perfect double top, but I think too many bars up here. So if this ends up as the high of the day, we'll probably need a micro double top here. Stop entry bulls who bought above 48 need 1 more tick, but I think it's better to be buying with limit orders. Limit order bears probably can sell above, but you might have to risk a measured move up. Do I think it'll rally for a measured move up? No. But, I showed that example earlier where the market did have a brief rally for 4 or 5 bars and then came back to the target. I think the market's going to have a hard time staying away from the blue line, the open of the week. So if it goes up, it probably will not go up far, and it probably will reverse back to the open of the week. Bulls getting a new high. Will the bears sell at the 40 high? They might, but they'll probably sell 1 point higher, 2 points higher, betting that we won't get much of a breakout. I showed that example earlier. If I can find it, I'm getting too many slides in my collection, but I think this is kind of like today, and we got a breakout for several bars. Let me increase the size of this to make it more obvious. Looks like we got about 5 bars up there. Traders deciding what to do. All right. I think very few traders, individual home traders, will buy at the high. They'll take profits at the high. But we have a subtle bull trend. This close is above this close, and each of these closes is above the prior bar's close, and that makes traders think that we might go a little bit higher. And I think it's okay to be short selling the 40 high, but I think we're probably going higher, so it's probably better to sell higher, like 1 point higher or 2 points higher. For the bulls, I think the buy was down here, moving average for the 36 low, or 1 tick above the 36 low, and most of those bulls scalped out and are back to flat. Big bar, so climax, similar to 31.32, but a pretty tight bull channel, and a lot of the bears will wait to sell until we go sideways more. First pullback probably bought because the bears will probably need a micro double top. We have 7 bars each with a close above the close of the prior bar. That usually does not lead to a reversal without the market going sideways first. Limit order bears selling 40 high. We don't know yet if they'll make money. They probably will. I think the bears are sold 1 point above have a better chance to make money. Stop order bears below 59. I would not do it. The channel is too tight and the trend is too strong. So probably buyers below 59 for at least a micro double top. What about individual traders? Will they buy the 59 low? Not if it closes on its low. They want to buy closer to the average price, the moving average. Maybe around the 58 low, the buy climax low. I do not think we're going much higher. I compared it to this, and I think it's a similar day. Gaps all the way up, final flag, tight trading range, one last burst up, and then a pullback. And I think we'll pull back. As I said, I still think we're going to close around the open of the week. But this looks like the bears will need a micro double top. And the first reversal down, probably buyers below. The scale in bears, they sold the 40 high and 1 point higher, or they simply sold 1 point higher, and they need one more tick. They'll probably get it. They might not get it this bar, but they'll probably get it in the next few bars. The bulls are trying to create a gap. They want to trap those bears, so they're buying right here trying to prevent the market from dipping below the 40 high. Because if they can prevent that, and then if it starts to trade up 2, 3, 4 ticks, those scale-in bears will buy back their shorts, and that will lead to at least a small second leg up. Useful information, right? The bears made money selling above 32, and now they've made money selling above 40 as well. That reduces the chances that we're going much higher, which is what I believe. I think we're not going much higher. 2-bar reversal, but probably buyers below. The channel is too tight, and we have 7 bars with closes above the prior close. First reversal down, probably minor. But now that bears are making money selling highs, they will sell above 59 if it goes there. Let's say we got a couple sideways bars. Bears will probably sell above the high of the sideways bar even before it gets to a new high. So bears will start to get more confident. Where do the bulls come in again? Probably around the moving average. Also, the stop entry bears need 6 ticks below 59. Since it's not a very good looking sell, they probably will not get it. That means the bulls will buy about 4 ticks below 59, which would be around the moving average, betting that the bears will give up. The bears only have 2 bars. Will they sell above 61? I don't know. It's a big enough reversal so that we'll probably get a second leg sideways to down to the moving average. And if we had a 3rd bear bar, bears would be more willing to sell above the high of the prior bar. So this is a bull flag. Bears might start selling the breakout of the bull flag, like above the 61 high, instead of waiting for a breakout above the high of the day, because they might not get it. We're getting late in the day. And as I said many times, the odds still are the market's going to close right around the most important price of the day, which is the blue line. All the bulls wanted to get was outside up, which is the green line. And now they want to get a bull body, which means they want the week to close above the open, which is the blue line. Too many bears trying to sell with limit orders at the 60 high and 61 high. Even with a bull bar closing on its high, 61, the market was not able to get above the high of that bar. Too many bears with limit orders to sell. We're back to the moving average, so we're in the buy zone. Will we go straight down to the magnet, the open of the week? Probably not. This is a higher high major trend reversal, but a tight bull channel, unlikely to lead to a major reversal without at least a small double top, and therefore probably buyers around where we are, maybe at the open of the week. 4 of the past 5 bars have bear bodies, but weak follow through, 61 bull bar instead of 3 bear bars, and then doji 62 at the moving average. Bulls are starting to buy around the moving average, and they'd like to keep a higher low above 49. This is, as I said, a higher high major trend reversal. In fact, it's a small expanding triangle top, low, lower, but I still think the odds are we're going to get at least a test up. You have limit order bulls who bought the 59 low and 1 point lower, which is right here. Limit order bulls who bought the moving average. And the bears, I think, will mostly scalp. Stop entry bears made money selling below 59, but I think most are scalping, which means they're buying down here instead of selling more. So we'll probably get a bounce here or soon. We're in the buy zone, the bottom half of the tight trading range around the moving average. But now we have a 6 or 7 bar bear microchannel. We know bears were trying to sell with limit orders at the 60 high, 61 high. However, I still think most bears scalped and that there'll be buyers around where we are. The bears have not done enough to flip this to always in short. With the 6 or 7 bars in the microchannel, a lot of bulls will not buy the high. It's similar to over here. Late in the day, you get a 6 or 7 bar bull microchannel. Even though it's in a bull trend, a lot of bulls will not buy the first reversal up. They'll buy a second or third. What about the limit order bulls who bought the 58 low? They'll probably make money, or if they bought more, 5 or 6 ticks below 58, I think they'll make money. You know, we may get up to the 58 low or maybe to within a tick of it, which would be around the 40 high. The bears will try to get a head and shoulders top. Can you buy on a stop? I would not. You know, the channel down is too tight. I would wait for it to go sideways for at least a micro double bottom. And the bears, it's too low to sell. They have to be selling higher, near the 40 high, the 59 low, the 60, 61 high. 2 legs up to a lower high, testing around the 62 breakout. Probably sellers around here. Bulls are hoping to get a trend up into the close, but I still think the open of the week is the most important price. And therefore, I think this will be a lower high. Sell zone. Stop for the bears. It's the end of the day, so they need a tight stop, a relatively tight stop, 59 high. And for the bulls, it looks like a bull leg in a trading range, and most bulls would rather buy low. It's still possible we could get buy the close, sell the close, but I've been saying for hours, I still think the most likely thing is that we'll close within a point of the blue line, the open of the week. Now, what about buying the 64 low? You know, we've got 2 legs down. We're right. If there were more time left in the day, sure, buy above 75 or buy the 64 low. But I've been talking for hours about the blue line being a magnet, and we're at the magnet, and we're running out of time. That makes it unlikely that we're going to get far from the magnet. So I would not. It's probably better not to do anything for the rest of the day. There's still a small chance this could become a sell to close trend, but the bars are small, and that makes it unlikely. Is it sell to close? I would not. You know, it's a very strong bull trend, and we're not getting a lot of urgency. Would I buy the high 2 with the 5 bear bars? I would not, because 5 bear bars, the market might need to go sideways for a few bars before it can go up. And we're right at the end of the day. And I've been saying all day, the market's probably going to try to close within a point of the blue line, which is where we are. And that makes it unlikely to go much beyond a point from the blue line. When you get these small pullback bull trends, they often get a pullback at the end of the day, usually 50 to 100% bigger than the biggest prior pullback. So here's the biggest prior pullback right there. Let's do it this way. And then it's usually an attempt at a pullback 50 to 100% bigger. And this is about almost 50% bigger. And most of the time, not 70% most, but more than 50-50, the bulls try to get trend resumption up at the end of the day. Here's a bigger pullback. Try to get resumption up at the end of the day after a little bit bigger pullback. Here it never had much of a pullback at all. Here it reversed, not pulled back. Now I'm trying to find an example of trend resumption up at the end of the day. This is the kind of thing that I'm talking about. That it's fairly common to get trend resumption up into the close. Here's another example. I am flat. To me, this was the last trade of the day. I like days like this because they're well behaved, they're fairly predictable, and there are a lot of opportunities to make money. And I don't want to say it's hard to lose money, because on days like this 25 years ago, I'm sure I would lose money. But now when I look at it, to me, if you read it correctly, it's difficult to lose money because you cannot be selling when it's doing this. And then you know that it's probably entering a tight trading range. So you're certainly going to buy and you might sell. And then once bears made money here, bears are going to make money here and here. So that was a pretty interesting day. I think the most interesting thing about today is Monday. This is the most interesting thing about today. Yes, it's a new all-time high, but I think more important than that, it opened on the high of the day and sold off all day. And usually the market does not do that. 80% of the time it gets back above that high so that the day has a tail on top of the chart, even if on top of the bar, even if it's a single tick. And I thought it was unusual that we sold off like that. And when we reversed up, I was wondering if we might, my first target was to get back above last week's high. And as the day went on and we started to enter a small pullback bull trend, I began to think that the open of the week is probably going to get tested, because remember, Monday was the open of the day, right? And therefore, let me go to the daily chart and show what I'm talking about. Okay, here's Monday. On the daily chart, it's really unusual to have the high of the day be at the open of the day. That's very unusual. And, we went above it today. However, if you think about it, this was a Monday, and that means all week long, the week had a high of the week at the open of the week. And, that's very unusual. Let me just check this bar. Okay, this bar looks like it opened on the low of the week, right? But it did not. There's actually a 1-point tail below because it's a weekly chart you cannot see. However, until a couple hours ago, this week, the current week, had an open exactly at the high. And just like on the daily chart, it's unusual. And on the 5-minute chart, it's unusual. It's also unusual on the weekly chart. When we were all the way down here, I did not think it was likely that we would get all the way back up to a new high. However, part of the reason why the market went all the way up to the new high, I believe, is because bars typically do not, when a bar closes, its open is not on the high or the low. And if before the bar closes, the open is on the high, chances are the market's going to try to get above that high and put a tail on top of the bar. If the open is on the low, then the week will try to get below that low and put a tail below the bar. And I did not think it was likely on the weekly chart because it had to cover so many points, but it did. And the result was that we went above the high, even though for 4 and 4.75 days this week, so almost the entire week, the week had no tail on top, and now it does. And I said that I thought the reversal up from last week's low was impressive, and then this rally at the close Wednesday was impressive, and I thought that Thursday was a bull flag. I did not think on today's open that we'd get all the way up to the all-time high and the open of the week, but I did think we would go up maybe to last week's high, and we ended up hitting every target. First bar of the day, a bull bar, possible low of the day. Nobody's going to sell on a stop below 1, but I did not buy on a stop above 1. And then bar 2, closing on its low. The bears need consecutive bars, and even then, I would be suspicious about selling. We have, by the time you get a consecutive good bear bar, you're right at support. 60-minute, 5-minute moving average close of yesterday, and probably just a deep pullback from this rally and gap up. That happens a lot where you get a rally one day, continuation the next day, and then a very deep pullback that looks like a reversal, but it becomes a bull flag. That's a very common thing when you get a gap up. Gap up after breaking above a trend, you got a deep pullback, and this is a bull flag rather than a reversal. Same thing here, deep pullback after a gap up, and it becomes a bull flag instead of a reversal. Gap up, rally, the low was yesterday, very deep pullback, but it becomes a wedge bull flag instead of a reversal. And I thought that was likely today, so I thought we were going to get a bull flag. Bar 3, we have a high 2 with bar 1. It's the second entry for the pullback back below yesterday's high. And my concern was 2 was so big that I thought it would be better to wait. And then 4 went below 3, so we have a failed high 2. However, again, I'm not selling down there, and I thought we might get a wedge bull flag. We have 3 reversals up, 1, 3, and then if 5 goes up, that would be a reasonable candidate for the low of the day. And then 6, we have a bear inside bar, but not a particularly big tail on the bottom. I said I thought we were always in long, and while it's not very bullish at this point, I would not sell below 6. And then 7, the day became always in long. Had a fairly big tail, and then had I right afterwards. So there was hesitation. The bears tried to reverse down 11, 12, and then we had an IOI on 15. And I thought 13 was an okay buy, but you might have to put a wide stop all the way down below 4. And then 15 I thought was a better buy because it was a second entry buy. And then we started to get small bars, 16, 17, 18, 19. So it looks like the market is forming a small pullback bull trend. Breakout 1920, not all that big. And usually when you get a small pullback bull trend, it's not climactic, but it's relentless. It just keeps going. And at that point, I thought it would be very difficult for the bears to make money. And whenever I conclude that it's difficult for the bears to make money, I usually buy. I usually try to buy either at the market or a pullback. The pullbacks are small, so I'm not looking to buy a 3 or a 4 tick pullback. I'm looking to buy a 1 or a 2 tick pullback. And it continued up here. At this point, I started thinking, maybe we'll get a parabolic wedge and then a tight range. Usually, if you get the parabolic wedge, you get a bull flag, a pause before you get a reversal. But this was enough bars to make me think we had to get another pause before a reversal. And then 31, 32, a bigger pair of bars. And so it's possibly a climactic end of the rally. That does not mean a reversal into a bear trend. It just means an end of the rally, trading range. And that's what usually happens after a buy climax. And then through here, traders started to think about selling above bars, like above 32 or the 40 close. I mentioned that the 41 open was 1 tick below the 40 close. And that tells you that as soon as traders saw shrinking bodies, 38, 39, 40, at the 32 high, they decided that it was probably going to enter a trading range, and they instantly just sold the market as soon as 40 closed, and then the 41 open is slightly below. 42, it's a pullback from a breakout, but at this point we're getting a lot of bars, sideways bars, small bars, dojis. I think we're probably in a trading range. And we have this buy climax 31.32. We're probably going to test the 36 low and the moving average. And therefore, I don't want to be buying 42. If anything, I'm looking to sell above bars. And I'm looking to buy at 36 and the moving average and the open of the week, the blue line. And there was a stop order buy above 49, but a tight channel. So the bulls probably will need a micro double bottom, which they got. And then they buy either above 51 or a bull bar 52, and then we got a bigger bar 58, but limit order bears either sold the 40 high and 1 point higher, or they simply sold 1 point higher. Stop order bears sold below 59, but when I think the market's in a trading range and a bull trend, I'd rather be selling at prior highs or above than with stops. Although if a stop entry bear took that trade, he made money. 61, we have a bull bar instead of 3 consecutive bear bars, but I thought with the reversal 58, 59, and now 60 dipping below 40, bears are making money twice here and again here. We're probably going to pull back down to the 49 low area, close to it, and the open of the week. And therefore traders would try to sell above bars, and you can see 61, 62 could not get above 61. Even though 61 is a bull bar, a high one bull flag. That means a lot of traders are trying to sell. That means we're probably going to go down more, and we went down for the next hour or so, a couple legs down. As far as buying 64, it's a 7-bar bull micro channel. Buying 68, I would not. Probably 2 legs up and more of a pullback, a lower high. You can call it a head and shoulders top. Not enough time to get a swing down. However, I thought when we had those 2 small bear bars, 70, 71, we were probably going to test back down to the open of the week. And as long as I'm selling at least 5 ticks above, I should be able to make money because it should hit the blue line. And so as long as I'm selling 5 ticks above, I can make money if it falls 5 ticks down to the blue line. So I try to sell 5 ticks above the magnet. And then here, I would do nothing. Stop entries today. Really easy to lose money if you get too eager, buying above 1, selling below 1, selling below 2 or 3. I thought the first stop entry buy that I would consider would be above 4, which would be hard, or above 6 or 7, 5 or 6, or you wait for the close of 7. And then 13, maybe 15, definitely yes. And then we're starting to get small bars. And it's okay to buy. It never looks good, but 18, 22, 26, I don't know, 30, I think it's probably going to be the final small bull flag before trading range. 37, I think it's okay to buy above 37 if you put a stop below 30, because we're probably in a tight trading range. In the first reversal down, we'll probably stay above the 30 low. And then buying above 42, I would not. Buying above 49, maybe. Above 52, probably better. And selling below 59, I'm in a strong day like this, and with a fairly tight channel like this, I'm only selling with limit orders, not stops. And then here, selling below, buying above 65, no. 6-bar bear micro channel. Selling above 68, no. Strong enough reversal, should get a second leg down and hit the blue line, so I don't want to be buying when we have a magnet just below. And then selling below 72, as long as if you're using a stop entry, the 72 low has to be 6 ticks above the blue line to make money, and it was. And then the rest of this, I think, is too difficult to trade. Buy the close, sell the close. Maybe bar 5 close because it's a wedge. We have 3 reversals up, 1, 2, 2, and then 3. Pull back from a gap up, and this whole day yesterday was a bull flag, and we have targets above. And so maybe buy the close 5, definitely 7, 8, and then any of these bars, they're all buy the close if you're not already long, but you might have to use a wide stop, maybe below 4. And then somewhere in here, traders concluded it's a small pullback bull trend, certainly by the close of 20, and then traders are buying for any reason. You can't buy pullbacks because there are no pullbacks. So you're buying at the market or with a limit order 1 or 2 ticks down from the high, and then just holding on for the way up. By the close up here, I would not. This is switching to a tight trading range, and I'm looking to enter with limit orders, buying below things and selling above things and scalping. So if anything, I'm doing the opposite. I'm looking to buy bear closes near the bottom of the range. And would I sell 58 close? No, but I would sell with a limit order 1 point above 40, and that could correspond to the same price. I don't care, but I'm not selling the close. I'm selling 1 point above 40. Limit orders, it's not worth doing limit orders here. The first limit order trade worth considering is buying the 8 low. And then next, you don't get a pullback until 28, but probably 30 is going to be a final flag. So 28 low is a scalp, and 34 low, we're probably in a tight trading range. And therefore, if you buy, you got to put a stop below 30 and scale in lower. And for selling above 32, a lot of bulls wanted to see what the breakout would look like. And when they saw 40, they didn't have a chance to sell above 32 because it did not go above 32 again. They simply sold at the market. And then traders bought with limit orders at the moving average, at a pullback to the open of the week, and at the 36 low. And then here, bears tried to sell above 61 with a limit order. How do I know that? Because I was one of those bears and I did not get filled. And that told me we were probably going to get a couple legs down. And bears could sell the 64 low, but I want to be selling at least 5 ticks above the blue line. And so they had another chance just to sell with a limit order 5 or 6 ticks above the blue line up here at 71 or 72. Strong enough rally so that we're probably going at least a little bit higher on Monday. But because of all the buy climaxes, I'll write about it this weekend. It makes me I'm not willing to buy position trades up here, so I'm not willing to buy Google or Apple or anything, Microsoft, and Caterpillar. And I want to buy a pullback, and I want to buy a bigger pullback, at least 5%, maybe 10%. I just don't. When markets are this extreme, I'm not going to buy that. And this is Microsoft, Google. Am I going to buy that close breakout? No, it's way too climactic. Amazon closed pretty well, and Apple closed well. Facebook closed well. Let me just check. I didn't look at Caterpillar. Caterpillar, we had that big gap up the other day. Not much follow through. I'm going to take a look at Honeywell. Okay, still forming a bull flag. And let me take a look at GE. The market's up strongly today. What did GE do? GE, when something's wrong with GE, right? If everything on the planet is going up, and GE is everywhere and owns all kinds of businesses, yet look at it, right? Something's crazy wrong with GE. Now, GE used to be one of the biggest companies in the world, but not anymore. You got other companies that are skyrocketing, and GE is plummeting. Okay, so GE is trading around 20 now, and back over here it was this monthly chart. Over here it was at 60. Okay, so back here market cap was 3 times bigger. So right now it's 1/3 of its prior market cap. Now its market cap is 186,000. So at one point it was 400, 500,000 market cap, and so it's the incredibly shrinking giant company. Do I think people are going to be buying GE soon? Yes, and that's because of value. Everybody knows GE is very unlikely to go out of business, and therefore there's some price when it becomes valuable. There's a theory that traders employ at the end of the year. It's called dogs of the Dow. Dogs meaning bad companies. There are 30 stocks in the Dow. And historically, if you buy a Dow stock that has a terrible year, you're going to do well over time. Companies only get put in the Dow if they're the bluest of the blue chips, the least likely to ever go out of business. And GE is still in the Dow. I don't know that it'll be in the Dow forever, but it's still in the Dow right now. And that means the Dow Corporation is telling you that they believe it's a very strong company and very unlikely to go out of business. So it's unlikely to go to zero. And take a look at this chart. Okay, let me do it and turn to a weekly chart. Okay, and put up a monthly chart. Okay, here's 40, here's 20, here's 0. What's more likely for it to do? To get up to 40, go up $20, or go down $20 to 0? Although it's not likely to go up to $40 anytime soon, it's more likely to get to 40 than it is to get to 20. Obviously, it's in a free fall. There are obvious targets below, prior major higher lows here, and possibly all the way down here. I don't think it's going to get down to $5. And if it did get down to $5, it would skyrocket. I think everybody would buy it because nobody believes it's going to go bankrupt unless the whole economy collapses, which is not likely. That was a fear back here in 2009 that the world may enter depression. So every stock collapsed. But unless we get another economic disaster and every stock starts to collapse again, GE is very unlikely to go to zero. And therefore, I think it's a reasonable buy. Would I buy it right here? Well, you know my style of trading. There's no way I'm going to be buying, 6 consecutive bear bars, right? Or, 9 bars without a bull body. I'm not going to buy this. However, I am looking to buy GE for a long-term hold. I don't know. You're my age, I'm almost 66. I don't know what long-term is. One of the problems you have when you buy stocks that go down a lot is dead money. Okay. By dead money, what I mean is they go down a lot. Everyone knows they're going to go up, but they can stay down for a long time. Twitter is an example of dead money. Let me put up Twitter. Everybody knows it's a great company. Let me put up the daily chart. Okay. Everyone knows it's a great company, but it's been just, put up the weekly chart. Okay. It sold off and then it went sideways here for 2 years. That's dead money. So you buy over here at 15 and, it stays 16, 17, 18, for 2 years, you're not making much money. However, everybody knows it's a very popular company and it has value. And if it cannot go down, it probably will go up. Yes, it might be going up because of takeover speculation. I don't care. To me, Twitter is a buy, or it's been a buy for 2 years. And how high can it go? Well, even if it only goes to this high, it's doubling where it was down here. This is 30, this is 15. So, you get 100% return. And yeah, it might take 3 years to get there, but you're making 100% over 3 years. And that's a very good return. GE is in this stage right now. It's in the free fall, but at some point it's going to start to stabilize and start to go sideways. And that is when traders will start to accumulate. And the short sellers start to give up because it doesn't seem to go down anymore. So when bears start to sell or stop selling and enough people get confidence that it's not going down, then it'll go up. So yes, GE is selling off. It looks like this or this right now, but at some point it'll start doing this. It's very unlikely to go straight down and straight up. Okay. It did that back in 2009 right here. Well, that's 15, but let me go to weekly chart, monthly chart. It did that in 2009 because the entire economy did that. But as an individual stock, it's unlikely to do that. More likely, it'll go through a dead money phase and go sideways for a number of bars, certainly a number of bars on the weekly chart. This is the weekly chart. But I do think GE is going to end up being an okay buy, even though it's right now in a free fall. Better to wait until it starts to base. And there's no rush. It's not going to go straight down and straight up. If it goes straight up, it'll be a minor reversal, and it probably will have to go sideways for several months before it can start going up again. Now, when you talk about some of the trades that you took today, gosh, I talk about this all the time that, I don't remember what I did. I know I bought during 7, I put a limit order after, I forgot, sometime during 7, I placed a limit order to buy, where did I get in? I'm trying to remember. I thought it was at 2570, but let me just take a look and see what that looks like. 2570, so I bought with a limit order 2570, and I don't remember if I got filled during bar 7 or bar 8, but I got filled somewhere in there. And then I bought the 20 close, and I bought one more time in here at one of those market trades. The market fell a tick or two, and I just hit buy the market. I didn't even try with the limit order. And then I did not buy the 28 low, but I should have. And I sold the 40 close, and I bought with a limit order one tick above the moving average, which was also at the blue line. And then what did I do? I sold over in here, and that was my last E-mini trade today. Now, what do you think about a straddle or a strangle in the current market? One of the reasons why you never hear traders talk about straddles and strangles on options action is because, in general, they're bad strategies. Okay. For example, let me just talk about what a straddle and strangle is. It's an option trade. And let me put the E-mini right here and put the spider. So the market's at 257. You don't know if it's going to go up or down, but you think it's going to go big one way or the other. So you buy both a 257 put and a 257 call, and you buy it far enough out, maybe 2 or 3 months out, so that you have time to be right. And so let's say you pay $4 for the call and $4 for the put. Your total expense is $8. That means it has to move either $8 up or $8 down to make money. And so that means you don't make money unless it falls all the way down here before your option expires. You can say, well, Al, options right now are cheap. The VIX is really low, and therefore buying options instead is a good thing to do. Whenever option premiums are high, it's better to buy spreads instead of outright options. But anyway, option makers, option institutions sell options, and they love selling you straddles and strangles. A straddle is, let's say it's a 257, it's buying both the 257 call and the 257 put. A strangle is buying a put that's lower and a call that's higher. So you might be buying the 255 put and the 259 call. And you do that because the option premium is less. So instead of $4, maybe you pay $2 for the call and $2 for the put. However, because it's further away from the current price, it's less likely to be profitable. So you get what you pay for. You pay less and you get less probability. So first thing, I can't remember the last time I bought a strangle or a straddle. What I have done, there's a thing called a delta neutral strategy, and I haven't done this in years, but I have done it before. So let's say you're long the spider, right? And and let's say you buy 2 puts. Let's say you're long the SPDR and it's now 258. You buy 2 of the 258 puts, and then you're in a delta neutral strategy, and you're only having time decay on your puts. If the market stays flat, you don't lose money on the calls because you don't own calls, and you only lose money on the puts. And if you draw the graph, owning the SPDR, let's say owning 100 shares of the SPDR and buying 2 puts is the same as being flat and buying 2 calls and buying 2 puts. So it's kind of a synthetic straddle. And you can do the same with the strangle. You can buy out of the money puts. I don't want to go into a lot of detail about that, but I personally don't do that. I usually pick a direction, and either if I think the market's going down, I'll buy puts. If I think the market's going up, I'll buy calls. If the volatility is high and if I'm going to be holding on to the position for more than a few weeks, I'll buy spreads. If the market's going up and it's very strongly up and I'm buying late in a climax and I think it might go a little higher, usually I'll buy spreads rather than outright calls. Back to questions. Some news announcements cause big swings in the market. What do you think about buying options before announcements and taking advantage of the volatility while limiting your risk in the case the swing goes against you? I don't know if you watch options action. They're always talking about catalysts, and most of the catalysts are earnings announcements, and most of the earnings announcements, the important ones, ended today. And but anyway, it's very common for options traders to buy options, puts or calls, or spreads, puts or calls, spreads, going into earnings announcements. I can tell you what I've done in the past is that very thing, going right into an earnings announcement. let's say there's going to be an earnings announcement on Thursday, and I might buy a weekly call that expires on Friday, and because it's a lot cheaper than buying one that expires 2 or 3 weeks out. Also, I'm only interested in the move that takes place after the Thursday announcement, like an earnings report. I've had it happen before. Usually going to an earnings announcement, there's uncertainty, and uncertainty increases the price of the option. If it's uncertain to you, it's uncertain to the institution selling you the option, and that means the risk is greater. To compensate for that risk, they charge you more money. And what I've had happen several times in the past, not in the past many years, because I don't do that anymore, is I would buy, let's say I'd buy a SPDR, anything, let's put up SPDR. So I'll buy let's say, I'll put up a stock to make it more specific. I'll pick any stock, Cisco. And let's say earnings were going to be next Friday, and Cisco's right now at 34. And I looked at the daily chart or the weekly chart, and I thought that Cisco is probably not going to go up very far. It might go down. So I buy a 34 put going into the announcement. And so if it falls below 34, my option will expire with some profit. Let's say I buy the 34 put and I pay 50 cents for it a couple of days before earnings, right? So if it goes below 34, it has to go 50 cents below 34 for me to make money. It has to go all the way down to the 33.50, because if it goes below 34, that's break even for the intrinsic value of the option, but I have to cover the 50 cents that I paid for time premium. And so if I'm buying a 34 put and I pay 50 cents for it, not only does it have to get below 34 just to start making money, it has to go below 50 cents below before I net money, because I had to pay for that option. And this is a long story let me get to the punchline. What I've had happen before is I'd buy the 34 put, pay 50 cents for it, and it would fall on earnings, maybe to 33.80, right? And you say, well, that's good. The 34 put, when it expires, you'll make 20 cents. Well, yes, I'll make 20 cents, but I paid 50 cents, and therefore I lose 30 cents. And other times, I've bought a put or a call. Let's say I buy the 34 put, right, the day before earnings, and the put expires the day after earnings. I buy the 34 put and I pay 50 cents, right? And earnings comes out and it doesn't move a penny. It stays exactly right here. And you think, okay, well, I paid 50 cents for my put. I can now sell my put maybe for 38 cents. No, so much of the value of that put was because of the uncertainty of the earnings report. Once the earnings come out, there's no more uncertainty. And yes, the price of Cisco is still $34.40, right? But the put that you bought yesterday for 50 cents is now worth 20 cents. So even though the market did not move a penny, it did not go against you, it did not rally, you lost 30 cents. So the point is, you got to be really careful playing earnings announcements. On options action, they're always looking forward to earnings reports, and they're always putting positions on going into earnings reports. And I do that too, but I don't do it for the reason that they do it. I do it for half of the reason they do it. They always say two things. It's at support, I'm going to buy a call, or it's at resistance, like a double top, I'm going to buy a put. And then they add something. It's at a call, it's at support, and Apple's going to come out with a new phone, or it's at resistance, and Cisco is they're trying to break into the cloud market, and they're just not going to be successful. And so they always add the fundamental reason, and I never pay attention to the fundamental reason. If I'm buying a call, I'm buying because it's at support or it has good momentum up. If I'm buying a put, it's because the market's at resistance or it has good momentum down. I don't add that second thing, the fundamental thing, which I think is just nonsense. You're betting that you know more than the institutions, and that your one little fundamental fact is much more significant from the hundreds of other fundamental facts, many of which you have no idea about, but the major institutions do. So, I'm honest and blunt. If I buy a call, it's because the stock is at support or because it's going up strongly. If I buy a put, it's because the market is at resistance or because it's starting to fall strongly. And I don't add that nonsense that I have these special powers that I can figure out what the one fundamental fact is that's going to override all of the others. I think that's witchcraft. So I don't do that. Okay, really interesting time. The buy climax just keeps getting more and more climactic. This is the weekly chart. Outside up, it's a doji week. Bull, doji, two bulls, doji, bull, doji. That's consecutive buy climaxes, and that usually results in a trading range, especially once you get 4 or 5, and now we have 4 or 5. And then all the other reasons for a buy climax, I think the odds are we'll probably get a pullback within a few weeks. I think the odds are we'll get it before the end of the year, because I think this is such a big gift on the year that a lot of traders will take some profits before the end of the year. All right, hope everybody has a good weekend.